Good morning. So this panel is going to be about unsolicited takeovers, activism, and defense. Nelson, the first question is for you. Just kidding.
Very fun.
That's not the agenda, and we'll stay away from specifics on that topic with any panelist. And Nelson, fortunately, you're well advised on the legal and financial front on recent events at your company, so we'll just leave it at that. We have an extraordinary panel of talent and experience in front of you. By my estimate, about 150 years of combined experience, 4 CEOs, 2 chairmen, 2 co-founders, a CIO, and at least 20 public and private directorships, all encapsulated with this group. Moreover, each person has led or transformed their company and business with substantial growth and or change from what it was when they took over their leadership role. During COVID, each public company CEO on the screen experienced significant stock price and market cap volatility, far outstripping the actual underlying fundamentals of their business and wreaking havoc on their business plans. To kick things off and to introduce you to our audience on the screen, I'd like to do a rapid fire Q&A for each of you. COVID impacted your business in a profound way. It also impacted how you had to manage and pivot as leaders. What was the single hardest thing you each had to do as a leader to navigate in COVID, and or what was the skill set you learned the most or had to draw on as a leader? If I may, we'll go across the top of the screen and we'll start off with Bill.
Thanks, Guy, and thanks for having me today. So we moved to a remote work environment as a result of COVID at the same time that we closed our acquisition of Interaction. Interaction was a very large public company in Europe that we acquired. We closed on March 13th and we went remote on March 16th. So instead of being on planes and trying to bring leaders and culture together to support integration, we were in our living rooms and we were on Zoom. So that was clearly a very different experience from to integrate 2 companies. At the same time, we were trying to navigate the safety of our frontline data center employees, customers, and partners, and we didn't really fully understand at that point just how serious and transmittable this COVID-19 virus was. So, fortunately, our operations team had many years of doing tabletop exercises for various disasters, including pandemics. So I would say the key learning in our case was to expect the unexpected and plan accordingly, as well as to continue to operate as a global company even more than before.
Thank you, Jason.
Yeah, sure. I mean, for me, it was making the active decision to do nothing. And, as a leader, there's always pressure to take action. And, in the case of last March, like draw on a credit facility or potentially cut the dividend, cut comp maybe, or maybe even do layoffs. And so, the hardest thing was to just stay patient, not take drastic actions and let things play out. And, it did play out and worked out well.
Glenn?
Well, there are many issues when COVID came about. We worried about operations, our tenants. We worried about our balance sheet. But when you think about the one element that we had to bring together, it was the employees. Because unless the employees got together, it didn't matter what operations and our balance sheet was going to happen there. They had to implement the plans. And what we found was communication was the hardest part. How do you communicate when you're remote? And trying to make sure we communicated was the most important element of it. We had constant meetings, we had town halls every 2 weeks, and the only way we could overcome remote was by communicating more than ever. And then what did we learn? I think what we learned was long-term remote is not the best way to run a business. It's hard you cannot communicate the same on a remote platform. But we've learned some elements relative to electronics to help us. But long term, we need chemistry. We need to be back in the office for us to be have our maximum efficiency.
Terrific. Nelson.
Yeah, I agree with everyone. You know, that when the shutdown occurred suddenly for all of us, not only did our team shift to work from home, but our entire buildings emptied overnight, and it's you know, it's dramatic, obviously, for all of us. I think, as Jason said, maintaining patience, calm, and focus through all that was quite challenging. And like Glenn said, the key was the team, keeping the team productive and communicating and focused and positive throughout was, I think, the largest challenge. Of course, our share price dropped by half, and we had investor concerns and sentiment to deal with, which we've been dealing with since. That's always an important part of it. But I think just keeping the people on our team focused and moving forward, driving forward with a positive frame of mind was key. You know, also last summer, we all experienced the social unrest from the killing of George Floyd and other things that were going on. And we, like a lot of teams, really leaned into that and spent a lot of time as a team focusing on diversity, equity, inclusion initiatives. And a lot of growth in team unity has really come from that. So we took advantage of this disrupted time to not only focus on our business and focus on keeping our buildings safe and healthy, but also just improving and strengthening our team. So that was a big part of our 2020.
And would you say team unity as a result of what you just described, team unity better, stronger than it was?
Yeah, no question. You know, there was a lot of hurt, as we all know, a lot of pain across our team. And we just leaned in and lamented together on several company-wide group calls and just talked about how our teams of all races were feeling about it and what could we do about it. And I think turning that into action, turning that into tangible steps, both within the company, within our communities, leaning into it and moving forward on various initiatives, I think it did strengthen our team. And I think we are much closer team today because of it.
Good for you. That's terrific. Kia.
So I think the hardest things and the lessons learned are related. For me, some of the hardest things were watching employees and investors who hadn't been in any prior real estate crises go through the stages of grief quickly at the same time that they're dealing with concerns in their own lives, in jobs if they haven't seen it before, that for a couple months looked pretty dire in certain sectors. So it was hard to watch people go through that and to lead them through that and to show them that there's a brighter world on the other side. And I think the lessons learned a little bit are just reinforcing what, a lot of you have already seen in your careers, is that, the right properties with the right capital structure in the right markets are very resilient, and having that faith through the crisis. There are lessons each time, but there are themes of what comes through. So on one hand, it was very difficult to watch people who hadn't been through a crisis before, but at the same time, showing them that there's reasons why we do certain things to protect our assets and focus on the future. So, reinforcing prior lessons learned, but managing a time when the business has some acute crises and your employees are dealing with it at the same time, I think was really difficult.
Thank you. And Mike, your business.
Yeah, I mean, obviously our business is a little different. And I'd say it was a mixed bag for us. It was at first, especially in the first few months, it was so intellectually stimulating trying to figure out what in the world this meant and trying to, opine on, gee, there's 17 different property sectors and each one's getting hit differently. There's short-term impacts, there's long-term impacts. What's this work from home thing? We were just so busy that I'd say the existing team at Green Street, we were functioning maybe at the highest level we've ever functioned at. And there were no distractions either. That's the good news. The bad news is that as time went on, we added a lot of people. We've been growing fast. We have added over 100 people in the last year, and I have not met them, nor have most of the senior people at Green Street. That's not healthy. We've got to rectify that soon, and we look forward to getting back into the office soon. So I think in our case, we learned that obviously you got to be in person, like Glenn said, to have a culture, and you got to, especially for the young people, to get to know each other, to find mentors. It's critical. That said, I think our business, we will continue to have a hybrid option. I don't really know what that means just yet. I think a lot of companies are grappling with that. But our folks will be working from home more than they used to.
Well, that was fascinating feedback to hear from leaders. Mike, you're leading a people business. Everybody else is leading a people business that oversees assets. Not one of you really talked about the real estate or the assets, and you talked about the people and the challenges with the people, emotional and training and managing people through a crisis, which I think speaks volumes about who you are, and no surprise that your businesses have by and large thrived as a result of how you lead. Mike, the title of this panel, as everyone knows, is The Bull Case for REITs Post-COVID and How to Play It. From your perch at Green Street, you've seen a lot in 30 years, and there is no playbook for running a business the last 12 months. From an economic standpoint, the quantum of emergency fiscal stimulus has been unprecedented. It needs to be paid. Some might say the fiscal stimulus from the financial crisis also needs to be repaid. Rates seem to be moving higher. Taxes are definitely going higher. 1031 exchanges that are very useful tool in the real estate industry are coming under pressure. What does all that mean for REITs? Is there a bull case for REITs post-COVID? And I might add, this, we all know this, but REITs they fell by 50%, then many of them have snapped back, and the REIT index is at or within 10% of its all-time high. So when you process all that, is there a bull case for REITs post-COVID? For everybody, for some, for none?
Yeah, I think there is. I think it's actually a really strong case right now. I think it's one of the strongest cases we've had in quite some time. And I'd start by saying, you did a great job articulating a lot of the worries out there, right? I mean, my goodness, we just added $4 trillion of debt, and now we're talking about adding more. I don't know what that does to interest rates. Maybe it means that this is the 60s all over again, and we're overspending, and we're going to be followed by the ugly 70s, right? When our interest rates spike. Maybe it means we're Japan. Maybe interest rates are going to stay low forever. I've learned in my career the best thing you can do with the interest rate question is just say, I don't know. Because then you focus on the things that you probably do know. And so that's one where we stay clear of, and thank goodness we have, because I think through my career, I think the concern has always been interest rates are going to go up, and I still have yet to see them do that in my entire career. It'll happen someday. I don't mean to trivialize the point. It's a very valid concern, but it will happen. But let's just say we have something of a status quo macro environment out there for the next 3-4 years. Modest growth, yada, yada. In that world, REITs are pretty attractively priced because, as you said, REITs aren't back up to their all-time highs yet. REIT prices have they've been range bound now for 3 or 4 or 5 years. Real estate prices, same thing. They're up a little bit in most sectors, down a little bit in some sectors, but by and large, they're not a lot higher than they have been 4 or 5 years ago. That doesn't sound too exciting from a valuation standpoint until I look at everything else in the world. And the only way I know how to answer the question is whether REITs are cheap or not is compared to what. And if I look at probably the best benchmark for REITs, we always look to the corporate bond market, and there we see that investment grade corporate bonds are trading within 50, 60 basis points of their all-time lows, which were just hit recently. The all-time low yields in that market were in the low 3s. That was earlier this year. We're now up in the mid to high 3s. By historic standards, that's a really, really low number. Much lower than it was through 19, much lower than it was through 15, 16, 17, 18. What I just said is even more true in the junk bond market. Junk bond yields are still within 30 basis points of their all-time lows. So we see the treasury market moving a lot, but when capital is flowing into risk markets, it's saying it's not that risky out there. And we're willing to accept yields that are extremely low. And then I look to the stock market as another comp. And if I look at, say, PE multiples on REITs, so price to AFO, PE multiples on the S&P 500, REITs have not looked this cheap in 15 years. They stack up very favorably relative to how stocks are priced. So those three metrics, compared to the two bond metrics, compared to the stock market, REITs are very favorably priced, which I don't think is wrong. I mean, we've seen an economic recovery that has shocked us, right? I mean, we were underwriting a much more bearish base case economic standpoint. I think everyone was 8 months ago. We're now using an economic backdrop that says by 22, we are back to 19 levels of GDP. Actually, by late this year, we're above, well above, and like 3 or 4% above, which means COVID from a GDP standpoint didn't happen. That's remarkable. And so it really explains the remarkable turnaround in REIT share prices. The fundamental backdrop for everybody's business has gotten a lot better versus where we thought we were going to be 8 or 9 months ago.
Thank you for that, Mike. Kia, what your day job is private investing, though you've been very involved in all facets of the industry and you have some REIT board experience. What do you think of what Mike just said?
So I agree with what Mike said, and I'll kind of make it broader to the real estate, public and private side. I think, our belief pre-COVID was that real estate was doing pretty well on the fundamental side, ex-retail, parts of retail, without huge economic wins at our back. And our view was, if you really got, a strong economic cycle, that real estate broadly, we thought had room to run. And I think some of that's going to be accelerated because of the snapback from COVID. Mike obviously has a broader perspective as he looks across asset classes. If I narrow it a little bit to just real estate, I think the growth, the snapback, the stimulus, we can talk about, ultimately whether that leads to other things, but I think it's generally positive for real estate. Clearly on the revenue side, some of the concerns we start to have, and you look sector by sector, are increasing expenses and wage pressure. So real estate that's a little bit more operating or people intensive, that's what could temper some of that. I think customer acquisition cost, as we think about it relative to office and retail, that capital shift to the landlord, have we priced that all the way, through the market? And then, as Mike said, when you look at, GDP and people's expectations, is it going to be a raid across the country? We focus on the US in the same way as it was before. Has COVID impacted the markets that are generating, that GDP, where is it, and kind of how it flows through real estate. And so I think, I think there are some very good wins broadly at our backs. Obviously, there's sector by sector differences, maybe tempered a little bit with some of the capital and expense growth that might keep it in line. But I agree with what Mike said.
And Kia, maybe being co-founder and CIO at Dune, and you've had experience both private and a window into publicly REITs through being on a board of a REIT. Did COVID change Dune's business plan, either offense or defense?
I think that I might not know the right sports analogy. Maybe it's most like basketball, that I know, from what I understand, I think there's a lot more offense than defense these days in basketball. But I felt like we went through that period of running up and down the court all the time, every day, playing defense on what we owned, but also making sure we were keeping an eye on the market and opportunities. And so it was running up and down the court every day. I don't think it changed. We happen to invest, mostly in disrupted sectors, and so I think it didn't change our core business, but it also underscores how difficult it is to make those decisions, the offensive decisions, during these times. And so even if you've done it before, still making an acquisition, and we committed to a fairly large transaction the first week of April, that really came to us because a very large institutional investor, a sovereign-like investor, couldn't make that decision, and we could. And I think that's, reinforces flexibility. But as much as I love what we do, it also is sometimes not easy in that moment. And I think we kept to fundamentals, but it's what is Winston Churchill, the darkest times are when you really know who you are. And I think that we stuck to our regular underwriting and just tried to remember the world, the world as it would be post a crisis. So, but for the people issues that we talked about, our core business stayed the same. I think it was just in the moment playing defense and offense. You really didn't have a break because you're dealing with people issues and customer issues and tenant issues. In prior crises, certainly let's go back to the financial crisis, there was a little bit of people were paralyzed longer in real estate. Here, there was liquidity more immediately. And so the offense and defense at the same time, that's why I think about basketball. You were really running up and down the court in a way that in the prior crisis was a little bit more defense for longer. And then, which I guess you can't play basketball with it only being defense. So I don't know what sport there would be. And then the offense started. Here it was immediate. And so we were running up and down the court kind of day after we closed the office. And so that was different.
That's very insightful. Thank you. REIT stocks fell over or about 50% from February 22nd to March 22nd last year. Nelson, Glenn, Jason, your stocks also fell about 50% in that period of time.
Thanks for the reminder.
But it got better after that.
There's a happier ending, right?
Yeah. In hindsight, what a phenomenal opportunity to use all your liquidity and go and buy shares. And in hindsight, clearly, maybe we should have done that and others should have done it. But few, if any, REITs, I think, including yourselves, bought their stock. Why not? Why, were there other things on your mind?
So in the case of Columbia, Columbia is a gateway office, gateway market focused office REIT. And of the 9 or 10 gateway office REITs, we fell the hardest, 60%. And I think that despite being 96% leased and good quality portfolio, I think that had a lot to do with the size and the scale, the lack of float. So we fell hard. We also recovered very sharply. So I think at the end of 2020, we were at the top of the list in terms of TSR. Nothing to write home about being down 30%, but there was a sharp recovery. But anyway, to your point, we did not buy back shares. We had a significant amount of insider buying, but it was a primarily a liquidity concern in those early days. So that was the primary driver there. But yeah, looking back, liquidity or no liquidity, it would have been a great buy for sure.
Glenn?
Yeah, we were not smart enough to buy our stock back. We just were not. But I think the circumstances were such that it was okay. We were not that smart. I mentioned operations and balance sheets were certainly important when COVID came in, but we needed our employees to run the business. So that was number one, as we spoke about. And now you have to fall back to operations and the balance sheet. And from an operations standpoint, although our collections actually turned out to be pretty well, we were not sure whether our tenants were going to pay the rents. We just didn't know. And we were in constant contact with our tenants, and they were telling us they didn't know if they could pay the rents. So we clearly had some issues coming from the revenue side, and from a balance sheet side. The most amazing thing that I kind of think back on is that we had a $1.5 billion revolver. We drew $500 million in March, which meant we were not sure Citibank, JP Morgan, and Wells Fargo would be solvent enough to pay us that $500 million if we drew it later. That is an incredible statement, frankly. And what makes it more incredible, in terms of your question, and why didn't you do it? Because stocks did come back. In November of last year, we issued $1.2 billion worth of bonds, 12-year and 7-year, at 2.7%, the lowest rates we've ever had. So over 6 months, we went from questioning Morgan Stanley and others' ability to fund us to going to the market and funding $1.2 billion, and we were 10 times oversubscribed. I mean, who could have ever projected that would have happened in 6 months? Certainly not us. I mean, in addition, we actually reduced our dividend, which in the REIT market, your stomach churns and your feet burn whenever you make a decision like that. But we did it because we were unsure of the duration of the pandemic. And I mentioned after we reduced our dividend, we reduced it to 44%, our stock went up 10%. So the market, at least at that time, understood that gaining liquidity was important. So it did support some of the actions that we took, but we did not buy our stock. And I don't think if you put us back in the situation, we would have bought our stock again.
That was helpful. And the fear factor, as you say, I think is an overriding concern that drives or overrides other perhaps decision-making. By the way, just I got to put it out there, Morgan Stanley would have been there for you. I'm not sure about the other banks, but we would have been there for you.
Well, we debated that, but we'll accept your conversation here.
Jason, what are your thoughts?
Yeah, I mean, we didn't buy any stock back either. There's the fear that Glenn talked about. I mean, our collections, ended up being quite strong throughout the pandemic, but we didn't know that in March. We didn't know that in April. And, even solvent companies, sometimes you think that they were just going to preserve their own liquidity and choose not to pay, even though they could and they should. It was also the pace at which the markets were moving. And then how quickly they recovered. If our stock had stayed depressed for a more extended period of time, especially once we had visibility into the strength of our rent collections, we would have considered it, more strongly. But it's a high bar to execute stock buybacks, and we would have to see a prolonged trading at meaningful discounts, and also not see any attractive or creative investment opportunities at the same time. And of course, everyone mentioned it. We got to consider the impact on the balance sheet, leverage, liquidity. You do it before doing anything like that. So for us, it was preserve our liquidity, our leverage profile, evaluate where the market was going. Were there going to be, interesting distressed investment opportunities? Were there going to be sale leasebacks to help, other companies generate liquidity? We wanted to make sure that we were, we had lots of liquidity for any opportunity that there was going to be. And then by summer, our stock had recovered, and, we issued a couple $100 million of forward equity in June, expecting that investment activity would pick up again. But as I said, I think it's a high bar to to buy back. When we think through capital allocation, it's that's one of the last things we probably want to do is buy back our stock unless it's really obvious. Unlike corporates, we don't retain any cash. This is really for all REITs for that matter. So we'd have to either sell assets or draw on a credit facility and impact the balance sheet in order to do that. So it wasn't high on the list, certainly. I think, as Nelson said, some board members and senior management, we did, acquire shares in the open market. I think it was in, mid-March, when our stock was in the 40s. We recovered back to the 70s by June. And we thought that was maybe the better way to instill some confidence, in the company, and kind of demonstrate our view that we thought the stock was way oversold.
Thank you. Bill, I'm looking at you, and you must be listening to this conversation thinking, what planet are these guys on? I'm living in an alternate universe here. Your stock actually rallied in the early days of COVID. Your peers were in awe, if not, frankly, a bit annoyed with you, and the different fortunes back then. What was going on at Digital Realty Trust?
Look, the last 12 months have been anything. There's been nothing like what we've all gone through in the last 12 months. And our hearts go out to all those that were impacted by COVID, especially those that lost loved ones. So no one was immune from the crisis, even the data center industry. But the data center industry was fortunate to remain open during this period while large portions of the economy were shut down. And business continuity is really one of the core tenets of the data center business. As I mentioned earlier, we have a full-fledged pandemic playbook that is designed to ensure service levels for our customers while prioritizing the health and safety of our employees, customers, and partners. The entire industry delivered a strong track record of operational excellence during this crisis, and we're proud of that. Digital maintained 100% uptime, and of course, we deferred some preventative maintenance. We asked customers to limit their sites to just critical activities, but our doors remained open, and our data centers continue to provide the trusted foundation for the digital economy. We were also in a position where we could give back during this crisis. And we did. We undertook extensive philanthropic efforts around the world. We increased our matching gifts for employees. We had various community outreach programs, all designed to combat COVID-19 around the world. I want to use this opportunity to express our deep gratitude to our operations team, particularly our frontline employees who were in critical data center roles that kept the data centers operating during this period of time. Despite obviously challenging environment and challenges at home, they performed their jobs so that industries, governments, and families were able to continue to connect, stay in touch, and keep commerce and information flowing. And that is our role in society within the data center industry.
That's well put. I think as leaders, we recognize it does take a village, and there's a massive village under that we're surrounded by. So that was appropriate comments. Thank you for saying that. Mike, what would you add to what others said? And you saw 4 out of 5 panelists. 3 out of 5 panelists in the public arena who saw their stocks get halved and by and large recover. And then Bill's stock had a small decline, and then in fact it went up and then down and then back up. So you saw you know what happened in the broader industry, and Green Street has historically been a big proponent of people buying back their stocks when it's clear that it's below NAV. But you also just heard from some pretty well regarded and experienced leaders. Yeah, of course, in hindsight, I wanted to, but you don't understand the fear factor and not knowing what's going to happen. What's your perspective? And then maybe if I may also ask, we've seen this from time to time. Did the REIT market, did they get it right? Did they overshoot? And have we learned something yet again about the depth and breadth, or perhaps lack thereof, of the REIT investing community?
Well, so REITs went down on average. They lost 20% of their enterprise value within a couple months after COVID set in. We were using a pretty consensus-like economic scenario for to build our assumptions as to what the NOI hits were going to be for every sector. And when we did that, and that was back when the economic assumptions were much darker than the ones that we're now using, that most people are now using. That was something like a 4% permanent hit to GDP from COVID. That's a big deal when you start thinking about impacts on valuations. When we added all that together, we could explain with an NOI hit something like a 10% hit to value for commercial real estate, i.e. REITs, the REIT property portfolios. The market was down 20. It does look like the market overreacted. Even based, I mean, we were saying it at the time that, gee, we can't quite fathom why these stocks are down as much as they are, particularly in some sectors. We now know that that was an overreaction. Large, but most of the rally has really been for the right reasons. With the news has been good. I mean, who knew we'd have 90+% efficacy on vaccines? Nobody did. The news has been, very favorable, and the economic news has been very favorable, and so the reversal of most of what happens makes a lot of sense. Did we go down too far? Yeah, probably. Are some sectors disjointed and maybe a little overpriced now? Sure, they always are. But by and large, the market at least directionally got it right. We would not, nor did we advocate that anybody buy back stock when everything, when the storm is raging. We're very often advocates for a REIT that trades at a big discount to its asset value to sell assets and perhaps buy back stock with the proceeds, but that wasn't an option. There was no private market for real estate back in April of last year. So any sort of arbitrage wasn't there, and I think a lot of the REIT management teams did a good job of just, if you're in an exposed business, the idea of drawing down your line makes sense. Not a lot of REITs weren't that exposed, but in some businesses, you needed to play defense in a big way, and hotel companies, the retail companies, by and large, needed to play some serious defense because you didn't know when you were going to actually collect rent again. So I think, with hindsight, we've had, I guess in the mall sector, we've had distress. We've had a couple of companies go down, but we're kind of probably on their way there anyway, small mall operators. But other than that, the lasting distress from this in the REIT space is minimal, if anything. So I think the REIT market once again, did a good job of showing its strengths. The access to the unsecured market, as was referenced earlier, was huge, and it was true in the global financial crisis when Simon stepped up in the darkest days and did a $1 billion bond offering to say, hey, this market's open. They had to pay 10% interest on it, but they proved the market was open for REITs, and that was a big statement. And it really helped the whole market. And this time around, the bond market didn't even need anybody to jump in at a high rate because the rates were low from the get-go.
Thank you. Bill and Kia, during COVID, you were on the boards of Host and Taubman respectively. And on the spectrum of most to least adversely affected REITs during COVID, your own companies or businesses were probably on the least adversely affected end of the spectrum, yet the two public companies where you served as directors were arguably the most adversely affected. What themes or advice were you able to offer from your own experiences to the Host and Taubman board based on your experience? And then what did you learn or take away from the Host and Taubman situations to apply to your own company?
Kia, do you want to go first?
Sure. Taubman announced a transaction with Simon in early February, right before COVID. It then became a contested transaction. So it made life really interesting, even more interesting during COVID. I think that in terms of the board and the role of the board during a tough time, it was a little different since we had a transaction going on, and our core job was really to look out for the best interest of the shareholders through our oversight of management. I think that watching a company go through its own existential issues in the mall space and everything that was going on in retail is that for the past couple of years, it was already something. Then you add on significant litigation and all the same things for companies and employees and customers and tenants. It ratcheted up the stress on the company to a level that I think as a board, we were very focused on helping support them through extreme crisis management. So I think that it was the skills taking from the private side. So we also, in my day job, we have about 30% of our portfolio is in lodging. And so what I also brought was that the acute crisis management on the property side, and was also able to bring the perspective of when we saw that coming back, and if we were seeing spending coming back, what would that mean on the retail side? So I think that the board was there to support management and to really give them perspective, because they were truly fighting on every front imaginable. Is that's when you really have to step up and be the perspective. A terrific management team, but for 24 hours, it was pure crisis. There wasn't a window because of the extra transaction. So we had to step up and sometimes just provide perspective and single-mindedly focus in some ways on the shareholder, since the management team had so much of the day-to-day. So we were really focused on what's the right outcome for shareholders and all these decisions that were being made. So it was really perspective, and that is what a board provides, perspective, not just oversight, but we also had board members by really design that were outside of the real estate industry. And that was really, I think that perspective was extremely helpful. That goes to the diversity, not just the DEI diversity, but just diversity in all forms, really comes into play during crisis management. Those different perspectives, I think, are really helpful. In terms of what it brought back to my business was, Taubman had great assets in a sector that had a lot of headwinds, but terrific assets. That focus on quality assets at the end of the day, even in crisis management, have a place and a value and a resiliency. That's always an important lesson. There's a reason during a difficult retail environment that Simon was attracted to Taubman, and it worked out. And the deal closed because of those same issues, that quality assets. It's a lesson that's always important for everyone in real estate to go back to what are the fundamentals. Great assets, even during difficult times, have what we think of as an enduring value in your portfolio. So I think it really, seeing that play through, just reinforced, and something that I brought back to that side. I would say that sitting on the kind of having that public-private perspective, at the end of the day, investors have very similar needs and goals. Investors want performance, great management teams, and transparency and leadership, whether you're public or private. And I think I saw that during COVID.
Very insightful. Bill.
So Jim Rizzolio is the CEO of Host Hotels. And Jim and I have been friends for a long time. We worked together at Westinghouse Credit. And we were there during the dark days of the S&L crisis. And in fact, Guy worked with some of your former colleagues there when you were probably a much younger investment banker. But no one knows how to play defense as well as Jim. So Jim didn't need a lot of lessons from anyone. I mean, core lessons, I would say, though, maintain liquidity and maintain the quality of the balance sheet. Host entered this pandemic with a great balance sheet, having pruned a number of lower growth assets. And their focus was on the burn during the pandemic. They're coming out of this crisis with a balance sheet that's in great shape. And as a result, they're able to take advantage of opportunities in the marketplace. They announced an acquisition of the Hyatt in Austin a week or so ago at a 10 cap. It's a very nice property. It's right across the lake from the city. It's on Zilker Park. I'm sure it'll be a great acquisition. And they're considering others as well. So,
did you do a site tour there?
It's funny. So my wife and I walk our dogs at Zilker Park, and we actually park our cars in the parking lot there. So we knew the hotel. We've been in the hotel to grab lunch, but we've never stayed overnight, obviously. I guess in terms of lessons that so I mean, the point is Jim not only knows how to play defense, so he's a great capital allocator. He knows when to sell, and he knows when to buy, and he knows what to buy and where to buy. In terms of lessons that I take back to digital, it's about capital allocation. And part of our playbook, unlike I think any of our data center brethren, is that we do prune our portfolio. We sell our lower growth assets, and we reinvest the proceeds in higher growth value add and principally development opportunities. So, we'll sell at 5, 6, 7 caps and reinvest in development at anywhere between 10 and 15%, and that's a good program. And Jim's doing the same, or he's done the same.
Terrific, thank you. And both those companies were very fortunate to have you guys on as board members. Jason and Glenn, why has the net lease sector performed so well the last few years? Is it all about low rates, spread investing, and yield? And if so, where are we in the evolution of net lease REITs in a potentially rising GDP and perhaps uncertain interest rate environment?
Glenn, I'll start here. Yeah, net lease REITs have historically been, underappreciated and maybe not had the same profile with institutional investors compared to more traditional REIT subsectors. It's really grown in terms of market caps, but also the number of companies out there. And I think you're right. I think in recent years, a lot of the performance can be attributed to the obvious market factors like persistently low rates and attractive spread opportunities. But I also think we benefited from greater institutional investor ownership, kind of a growing acceptance that, there's a place for, in your portfolio with, an investment that provides safe yield, stable growth, in a really a variety of different market environments, through growth periods as well as through recessionary periods. So I think net lease has become a more mainstream holding for large public REIT investors. I think there's, probably still also we're under owned and maybe still trade at a relatively low multiple compared to many of the other REIT sectors. So there may be additional room to run as a sector, as investors increase their allocations, compared to certainly the historical underweighting and in many cases maybe ignoring altogether net lease. So, I think that's where the the sector has gone and maybe why there's been some outperformance. And I think the concerns about rising rates, they're probably a little overblown for REITs in general. I mean, for us, WP Carey in particular, we feel like we're well positioned, and maybe we'll even outperform, especially amongst our peers during a rising rate period. Balance sheet is we've kind of recast the credit facility, we've pushed it out. We have very few mortgage maturities coming due, and what does come due, it's at higher rates. I mean, our mortgage debt remaining is around 5%. Our US dollar bonds, the next maturities in 4 years or so are at 4.5%. So even if rates do increase, I think our refinancing activity should still lead to interest savings for the foreseeable future, and will also provide interesting spread opportunities for new investments. And then, lastly with us, and maybe this is a bit unique, we have a pretty good built-in hedge within our lease structure. The majority of our investments, I think it's about 2/3, are linked to inflation. So, to the extent rising rates are correlated with higher inflation, I think that, we should see some, maybe better internal same-store growth than a lot of our peers in a rising rate environment. So, I think the fact that we have long-dated leases and typically that's the most eroded by rising rates, that's a factor. But again, I think our lease structures perhaps can provide some offsets to that.
Well, I guess I go, Jason's been at this lot longer than I, and frankly, when I got into this business, I didn't know why it's a good business. I mean, I really didn't. But I suspect it is a good business. But the way I think of it is, what we do is I hate the phrase triple N. Triple N is a reimbursement formula. It's not a business. What we do is we provide equity. We provide equity to corporate America. That's, we're a bank. We provide equity to corporate America in a variety of ways. And that makes sense. And what corporate America wants from us is they want full funding on real estate, but in return, they want a long-term lease so they could house their business. I mean, many of the properties we own, you wouldn't think we own them, you would think our tenants own them. Most people think our tenants own them because they need that housing for a very long time. So the trade is, we provide capital at reasonable rates, and what we get are long-term leases that provide stability. And that's the simple business we're in. And just as Jason mentioned, some investors will want that. We're not a 15% IRR business. Maybe we're an 8 or 9% IRR business, but long-term stability. And we certainly have proved ourselves, both Jason's portfolio and our portfolio, we're collecting 99% of our rents, right now in the pandemic. So we've proved that stability does exist, and that's the business we're in. And that, I think, could be a good long-term business for people who want long-term, good, stable income streams. In terms of inflation, I sometimes thought of inflation, it's a little bit like cholesterol. There's good cholesterol and bad cholesterol. We lived through bad inflation. Those of us that are older, in the 79, 80 era, some people were, well, I guess everybody was born then, but not everybody lived through it. That was bad inflation, right? That was bad. Right? It seems to me that GDP growth inflation is what we're looking at now, is better inflation. And from our standpoint, as long as our tenants pay rent and our businesses are doing well, the rest of our business will do fine. And we're all relatively protected. Our balance sheet, just like Jason's, we're 99% fixed. We have not a lot of maturities coming due. What we did do was we raised a lot of equity on the balance sheet recently to bolster it, which I think is good. And so we feel from a balance sheet standpoint, we're not hurt. As Mike said, we can't control inflation. So we're going to worry about what we can control. We can control the balance sheet. We have step-ups in our leases that should help us, both fixed and CPI. And from an acquisition standpoint, we spread invest. And over time, if rates go up, cap rates should go up as well. We know there's lag involved, but we have staying power to deal with those lags. So we'll deal with what we can control, and what we can't control, we'll just make sure we protect against.
Thank you. Switching gears a little bit, Mike and Kia, we've seen our first sizable REIT public to private transaction in 2021 with the collaboration by Blackstone and Starwood to buy Extended Stay America. Kia Dune is a hotel developer and investor. Give us your perspective on the transaction. Why did it make sense? Or maybe why didn't it make sense from your perspective? And then Mike, I'd be interested in your perspectives on M&A activity in general, more broadly in 2021, and what's your perspective on that is in terms of whether we'll see public to public activity and some more public to private activity, and why or why not?
So I was really quite pleased to hear about the transaction. You know, Dune is an active investor in this space. We have probably just under $1 billion in this space, and I've been investing in it probably for 20 years. So I was thrilled by seeing it, the investor acceptance, and clearly the valuation, which was, I thought, quite attractive. You know, that sector, I think what has always attracted me to the sector is that, you know, there's a defensiveness to the sector. I'll go into, there is a, in my experience, a reliability of cash flow, but it always offered, I thought, you know, extra generous yields because it wasn't as institutional and it didn't attract institutional capital. And I think that was changing before COVID. And I think COVID has accelerated the acceptance of, you know, larger parts of the lodging market. You know, way back when, you know, hotel REITs were clearly focused on, you know, full service meeting hotels. And that's what the acceptable box for REITs were. You know, as with all the other asset classes, everything has expanded, broadened, lines are blurred. You know, extended stay in particular was always a mix of lodging and residential when you really looked at the operations and the mix. And so it didn't really fit into a bucket. Now that people are comfortable that lots of assets don't fit in buckets, I think it's attracting more and more institutional capital. And so I wasn't surprised. I was very pleased, but wasn't surprised that you know, the buyers took advantage of maybe a misperception in the market at the time relative to operating fundamentals.
Then I guess to the second part of the question, I would just say that you know, we've had a big recovery in share prices, and with that recovery, we've seen a lot of the potential for public to private go away. So yeah, there's a few apartment REITs still trading at discounts to NAV, but by and large, those are small discounts. That's true for some of the hotel REITs, not all of them anymore. But even there, the discounts aren't particularly large. The only sector that's where NAV discounts are pervasive is office. And I'm sure we'll see a deal or two over the next year or two in terms of privatizations. But you know, the office companies have had a chance to take advantage of these trades now for 5 years because they've been trading at discounts for a long time. And you know, it may be social issues. It may be that there's really not a big portfolio bid in some instances. I don't know if there's really anybody out there who wants to buy $7 billion of New York office right now. So it's, you know, I don't think we're going to see a lot of that activity. I think the door is open for public, but I don't think it's particularly wide open. I just wouldn't be surprised to see a few deals here and there. I think the pace will be kind of normal, which would be maybe, you know, 1 or 2 privatizations, 1 or 2 publics over the course of the next 12 months. So I think you're going to see some, but not a lot.
Very good, thank you. Jason and Bill, you've continued to lead international expansion for your companies. Did COVID cause you to pause or accelerate that strategy? And looking forward, post-COVID environment, will you recalibrate or accelerate your international expansion?
I'll start here, Bill. I mean, for us, diversification has always been a key, aspect of how we invest, and COVID didn't change that. We see downside protection and diversification. We also see a broader opportunity set when we can, invest across asset types or tenant industries or geographies for that matter. So, international, it hasn't changed. We've been investing in Europe since 1998. We have 50 people on the ground in Amsterdam and London. We have a platform that's based there. So, we're well established, and this didn't really change anything. And the benefits of investing in Europe, really haven't changed for us. I mean, namely, there's less competition over there in net lease. There are no public European net lease REITs. I think many people think of us, as the de facto public European net lease REIT, given the size of our platform there. There's much less competition, because there's pan-European investors either generally in net lease, which we are. And because of that, there's more meaningful spreads. I mean, the borrowing costs are meaningfully lower. Our spread opportunities look better. There's also high barriers to development in Europe, generally, with more green space requirements and more difficulty just to develop vacant space, and there's less supply. I mean, we don't invest in much retail in the U.S., but we see Europe as a great opportunity. There's the stats range, but I've seen there's 8 or 9 times more retail real estate per capita in the U.S. compared to Europe. So that's where we've been investing. And so I wouldn't say there's really any rethinking on our international business. We'll continue to pursue growth in Europe. We'll continue to access European capital through the Euro bond market. We're mainly focused in Northern and Western Europe. And I would continue to expect to see our portfolio grow. It's about a third right now of our ABR, and I would expect it to kind of stay in that similar range.
Thank you, Bill.
Well, our global expansion accelerated meaningfully over the past 12 months. I'd mentioned the acquisition of Interaction in March. So I wouldn't say that it's as a result of COVID, our international growth, but it's certainly a coincidence. The Interaction acquisition really was a step change for us in terms of accelerating our global strategy. In Europe, we now offer our customers access to 70% of the GDP in Europe. And in the fourth quarter, over half of our bookings were from Europe. That was the first time that more than half of our bookings were non-domestic. It's also worth noting that we expanded opportunistically during the last year. We bought a platform in Greece. We bought a platform in Croatia. We expanded. We bought land in Mexico and Chile through the Ascenti platform, and we're building out our African business through ICOLO in Kenya. There's certainly more work for us to do in integrating the Interaction platform, but I think we've made really good progress, and we're also expanding in Asia. We have the first carrier neutral data center in Seoul. We're looking for additional opportunities in South Korea. We are building out in Singapore. We bought 2 parcels in Sydney to expand our campus there, and we'll most likely be adding additional locations in Asia. So I wouldn't say that our expansion is as a result of COVID, but it's really part of our overall strategy. We think it's important to have a global platform in order to appropriately serve our customers' needs.
Okay. I'm going to ask two more questions, and I want to just go to a quick rapid round of Q&A of each of you. My 2 more questions, one back to you, Bill. When you joined, and the second is going to be related for Nelson, please. But Bill, when you joined Digital Realty in 2004, you became interim CEO, and the market cap of the company was about 12 billion. Today, it's almost 60 billion. A pretty remarkable run. And the company is clearly at the forefront of the digitization, and really is a juggernaut. Just listening to what you were saying about the international expansion, so a lot of those countries we vacation to versus run a very big business in. But there does seem to be no bounds to what you can do with the international expansion. But where is Digital Realty Trust in its evolution? Are we in the 8th inning or in the 3rd inning? And when we return to office and diminish work from home, does that change anything for you?
Guy, I think we're in the 3rd inning of a doubleheader.
Okay.
And this is the first game.
Yeah.
You know, when we IPO'd in 2004, we had 15 data centers and 23 properties, 1 in London, the rest in the US. And our business was mostly about space and power. Today, we're an S&P 500 company. We have over 280 data centers. We're on 6 continents, 24 countries, in 49 metros, over 4,000 customers, over 2,500 employees. When we IPO'd, I think we had 15 employees. We operate in, I think, what is clearly a more complex and competitive global arena, but we think there's more opportunity than ever before. And this, as I said before, this combination with an Interaction represented a huge strategic shift for us. I think in terms of what will change coming out of the pandemic, I mean, we have these mega trends that are just going to continue to drive our growth. And it's actually going to, I think, accelerate our growth. You have the ongoing shift to the cloud. You know, the cloud service providers are continuing to grow out their platforms at a tremendous rate. And they're outsourcing to data center providers like ourselves. You have the social networking company, artificial intelligence starting to come on in a big way. The Internet of Things and autonomous vehicles. So customer demand is really accelerating, in our opinion. We're also, because of COVID, we're seeing these shifts in remote work, which has implications for bandwidth, you know, and online commerce. I mean, COVID certainly has accelerated, but it was really starting before COVID. So we think we're in a unique position to help our customers continue to support their need for infrastructure, IT infrastructure on a global basis, both in terms of hard assets as well as connectivity.
Okay, so you're in the 3rd inning of a double header. Nelson, you probably like it to be the bottom of the 9th with bases loaded to end the game. What do you think about what Bill said, and where are we in the office sector recovery? And admittedly, every office company is different, but broadly speaking, what are your perspectives?
Well, I'm getting ready to start. I'm getting ready to start a new game. I'm looking forward to starting a new game altogether, I think. But so we're only about 15% occupied in the gateway markets. You know, most of our portfolio is in New York and San Francisco, and we all know that there were challenges in those markets even before COVID. Infrastructure, housing, and other issues. There were some headwinds already. But, you know, again, we focused on tech and media. More than half of our tenants are tech and media across the portfolio, and those companies have done quite well. And so, you know, 95% leased, 98% collection. So we started from a pretty good place, but there, you know, there's a lot of unknown in the sector, in our business. And I think the challenge is to be on our toes with meeting those new needs. The office is changing. We all know that. We all are experiencing in our own businesses. We all see it with our tenants. I don't think that translates to smaller footprints necessarily, at least not for a lot of tech and media companies, but the space will be used differently. And work from home will continue to be a component. And we know that. So it's always been a differentiation game. There's always been plenty of empty office buildings around New York and San Francisco, right? Or underutilized buildings. It's always been a challenge of differentiating and meeting tenant demand. So that just got a little more challenging, and it has a couple of new and different twists. But the team is very excited about it. We're spending a lot of time this year talking with our tenants and prospective tenants about the new workplace and what that means. Shorter lease terms are going to be in vogue, no question. We and tenants will spend more dollars on reconfiguring space. There will be some challenges, but I think the landlord that can differentiate is going to do fine. There will be some long-lasting impacts on work from home and other factors. But you know, we feel good about a bounce back, and we're already seeing that even with news, just news on the vaccine success. We're already seeing a lift in our sector, and as Mike said, we've got some room to run here. So I think the biggest challenge and the most exciting opportunity is you know, meeting the shifting demands of office users, and you know, we're pretty optimistic about it overall.
Thank you. Thanks for those insights as well. We started off with kind of a speed round question, and I'd like to end with a few. I'm going to ask put out three or four thoughts, and I'd like each of the panelists, perhaps in the order that we started with, which on my screen is Bill, Jason, Glenn, Nelson, Kia, and then Mike. This one's coming out of left field. When I say the word SPAC, what comes to mind?
Caveat emptor. Bubble. And I think it's a great option for the SPAC sponsors, but it hasn't always worked out well for the shareholders.
Yeah, agreed. Someone's going to make a lot of money on SPACs, but I think in most cases, it's not going to be the investors.
I think in investment pressure, anytime you have to make a deal, it doesn't sound right to me.
Yeah, whether we're talking about it this time next year or later this year as a hot item will depend on a few of these, you know, headline deals we work in others and their success.
My word is puzzled, head scratching.
We've seen it before and it never ends well.
What sector do you think is going to be the best performing REIT sector, best performing and worst performing next 12 months from looking where we are today? Bill?
Well, I'm going to talk my own book a little bit and say hotels, which is, I suppose, actually the host book. But I think given where the sector has been, and I mean, I've been to a number of hotels recently, they're destination properties, and they're full. And I think, you know, once business travel picks up, I think the hotels will do great. I think the sector that I'd be most concerned about, and I'm sorry, Nelson, but I'll say CBD office. You know, I think there's a migration from the high tax markets, New York and San Francisco, to the lower tax markets. I think you see work from home as something that will continue to some extent. There'll be a more distributed workforce. So maybe an emphasis on offices that are closer to home. And there's certainly more sublease space in these major markets as well.
Yeah, I'm going to say hotels as well. I think there's going to be a snapback in leisure travel. We'll see what happens with business. And unfortunately, office is also on my list. And I'm going to leave Glenn. Glenn, it's your job to say net lease for the upside here.
Well, I'm not going to talk my book yet, but almost. I think shopping centers. I think well organized shopping centers will come back strong. Not malls necessarily, but shopping centers. And on the other side of it, I don't really know. I would worry about urban office. I respect everything you said, Nelson, and I think differentiating is very important. And so we're in a business of specific information, not general information. So if I say urban office, I mean those that are not differentiated.
So Bill and Glenn, accepting the challenges, there are no question there are significant challenges and headwinds in CBD office. We still have some room to run in recovery in terms of share price performance. So in terms of just outlook and share performance or investor performance over the next year, I like office. Again, talking home book a bit, but again, that's not acknowledging the challenges, but realizing I think the market is oversold relative to those challenges still.
So I think anything consumer facing is going to have a great year, and that includes all sectors of travel and leisure. And I think, as Glenn said, parts of retail that are going to benefit from just the buildup and the snapback, and the savings rate that we're going to really touch on. The savings rate combined with the stimulus, I think it's going to get a huge lift to anything consumer facing. I don't want to pile on to office, it's been said, but if you could create a portfolio of office in knowledge market that are new buildings. I think that might outperform what the market thinks. In my experience, I haven't seen a spread between new and existing office demand this big, even if demand isn't the strongest it's ever been, but the demand for newer office in knowledge or creative or techtainment markets, I think is a subsector that if you could play that, I think that would outperform in the next 12 months.
Yeah, I think some of the answers have been directed at which sectors are going to see the best operating performance rebound, and others have been directed at what looks cheap now, because as we've talked about on this call, we've seen a huge price recovery. So the things that look like they were going to have an awful time and now look better, a lot of that's baked into the share prices. So the question we try to answer all the time is what sectors are priced most attractively, and the ones that screen very favorably these days are gaming REITs, manufactured housing, which usually screens very favorably for us. It's the world's best real estate business there is. And then single family rentals attractive. The talk about wind at your sails for a long time to come, as you know, we've seen demand push forward several years in that sector, but we think it's got room to go. And then the ones that scare us from a valuation standpoint are malls. We think lodging has gone a little too far now. And then unfortunately, I'm going to pile on office again, but you know, this is a methodical approach we take towards it, and those are the ones that just look pretty pricey right now.
In March 2020, the US Treasury was 10-year was 60 basis points. End of the year, it was 100 basis points. Now it's 167. Where will it be a year from now? Bill?
So if you look at swap rates, 12-month forward 10-year is 2%. So I'd say somewhere between 2.5. Let's call it 2.25.
Is that your final answer?
2.25.
I'd like to take Mike's approach, which he just says he doesn't know, because I don't know, but I think you're going to force us for a number, so I'll say 2.5.
I'll say less than 2.
2% for me.
212.5.
No, there's students on this call, I presume, and I'm just going to continue to harp on the fact that I think it's counterproductive for people to base business strategies or investment decisions on predictions of interest rates. So it's an interesting parlor game, but I think it's, you know, as you get into your careers, I would avoid that question. So I'm going to avoid it.
All right, well then that's going to cause another question for you, Mike. Will the REIT index be higher or lower in terms of 2021 performance versus the S&P?
Oh, I think we're going to outperform. I think you know, per all the comments I made earlier in the call, I think REITs in aggregate are pretty cheap. You know, some sectors more than others, but if you just look at where we've traded historically relative to bonds, where we're trading now, we're cheap. Where we trade historically relative to stocks, we're cheap now.
Okay, last question for everybody. In just a couple of words, in your own words, what's your biggest worry right now as a leader?
Look, I think it's black swan events coming out of government policies. We've obviously had a change in administration, change in control of houses of Congress, and we have a group in power today that places a greater priority on social programs than economics, I would say. And we've seen in the past how that has played out. You know, and you don't know when or how long or exactly what it's going to be, but it can have disastrous consequences for the equity markets, the fixed income markets, and a spillover to the economy at large.
Yeah, for me, it's, you know, maintaining culture. You know, we've been around for 50 years, and that's you know, probably the most important, you know, component of our business. And with work from home, it makes it difficult. And you know, it's funny. I think it's going to be more difficult to return to work than it was to begin working from home. Just the momentum that we have, and the, you know, what people are are getting accustomed to. And it's important to get back together. I think everyone echoed that, and we'll do it. But I think there's going to be certainly, it's going to put pressure on the culture and the people and, and retention for that matter. So.
I won't go macro, but from a micro standpoint, if our tenants continue to pay rent, everything else will be fine.
I agree with Jason. The back to work is going to be a challenge. Maintaining culture is going to be a challenge. Change is hard in general. And our sector, our industry in particular, as we've all discussed, is going to go through, to succeed, we're going to have to go through substantial change and innovation. A big shift in how the future of the office and how we meet that. So staying focused, staying optimistic with the team, but also really stepping out of our comfort zone, doing things differently, and embracing change is I think is the biggest challenge.
So for me, what keeps me up at night is inflation, and whether, I think as Glenn said, whether we're going to have good inflation or bad inflation that comes off of everything that's being pumped into the economy. And I'd echo what Bill said. What we look at is the increasing volatility and unpredictability of government regulations, whether that comes local, federal, state, and the impact on real estate, the convergence of some social policy, which might be beneficial and terrific in the long run, but the bumps it creates for real estate in between, that volatility and unpredictability impacts pricing.
Yeah, and I'd throw in modern monetary theory. I think it didn't make sense to me when I first heard about it. It sounds like you don't ever have to pay your debt. And it doesn't make sense to me now. And it feels like there's a lot of talk that we should go try it. We've spent $4 trillion already, much of which was warranted on COVID relief, some of which probably wasn't. There's $3 trillion more that's on the table right now. And I haven't seen any politician talk about paying for any of this with a credible plan. So we've seen this before in the US and it doesn't end well. We've seen it in other countries and it doesn't end well. So in terms of things I'm worried about, that's probably the biggest one.
Thank you. Each of you impress me. You always have. Getting this whole group together has been remarkable, particularly for the NYU students. We went overtime, way overtime. Thank you for permitting that to happen. You guys are awesome. Thank you for being generous with your wisdom and sharing with the NYU students your perspectives. And congratulations to the NYU students for getting exposure to such an esteemed group and a great conversation. Thank you.
Thank you all. It's a pleasure.
Thanks,
Thank you.
I appreciate it.
Thank you.